So let's get started talking about trading the trends. Now, in today's class, I'm going to use the term security, but I might say Facebook, I might say Google, I might say Bitcoin, and in fact, I know I'm going to say the euro. But I'm not talking about any of these specific individual assets. I'm talking about all assets that are traded in the financial markets. Similarly, I intermix the terms investing and trading. We know the difference. Most of us here are traders. Traders take place in a much short-term objective, and we're looking to make quick profits. Investing is a whole different scenario. But I intermix the terms because otherwise it gets very boring just saying trading, trading, trading. Now, whether I'm giving a seminar, whether I'm going to a presentation, whether I'm heading up a webinar, whether I'm at a one-on-one or a conference, seems to be the question everybody wants to ask, especially my friends, is what should I buy today? What will the prices be tomorrow, next week, or next year? Now, wouldn't investing be easy if we knew the answer to these seemingly simple questions? Yeah, it should be, but nobody has a crystal ball and nobody has a Ouija board. The fact is, technical analysis and trend strategies can help you make smarter decisions. And they will. But they're not the answer to it all, because understanding what you're doing and building your plan and being cautious is what it's all about. Now, trend following is perhaps the most popular longer-term strategy in all financial markets. As a trading strategy, it is exceedingly effective and profitable when conditions are favorable. Now, in order to start in any trend following strategy, we have to understand what we mean by a trend. And trends and trend lines are quite different. Now, a trend is any decidable movement. Whether you want to look at the trending cars and you can see that more pickups are being sold and less four-door sedans and more two-doors and more hatchbacks, that can be a trend. Women's heels could be getting higher. Dresses could be getting longer. We could be looking at more ranch-type houses and less two-floor houses. Okay, when you can identify a particular movement, you're looking at a trend. In our market, what we're looking for is price to make a higher high, then a higher low, then a higher high and a higher low, and a higher high and a higher low. Because price moves in a zigzag fashion. Price doesn't move straight up. When you see price moving straight up, there's something weird driving price. A well-developed trend is a series of higher highs and higher lows, or in a downtrend, just the opposite, a series of lower lows and lower highs. Now, I firmly believe, and what I tell all my students, is that price action or price movement is completely random, because it's made up of millions of human beings making decisions around the globe. How we're making those decisions is all different, and what affects those decisions are all different. Say you have a trader from a big Wall Street bank that trades billions of dollars a day. Okay. Now, fact is, he would have bought the euro this morning at 118.42 when he got to his office at 7 a.m. But the fact is, he was getting ready to leave his house. The wife started yelling at him about something. He got delayed. Then he went to leave out the driveway, and there was a problem with the door in the garage, and there was somebody else on the street blocking. The trash men were blocking in his driveway, and he was a little bit late. And he was rushing, and he got stuck in traffic, and he got stuck behind a school bus. So now by the time he gets to the office, he's running late, and he's annoyed and aggravated. Now, you ask me, what does this have to do with trading? Well, that huge trade he might have made under normal circumstances doesn't get made, because being human fits into the equation. Okay. So crowd behavior is ultimately important. And this is why the markets are random. Now, trends are created by powerful underlying economic factors that may not be all clear at all that time. Now, granted, in the short-term market, we're not as concerned with the overall economic factors. I'm not talking about the economics counter. I'm not talking about a jobs detail. We're looking at trading over a couple hours. Now, simply, patterns are created by price action in response to human emotion, economic events, and other things that we can't say. People say it's supply and demand. Now, how do you actually calculate supply and demand? Now, for instance, I'm not a big cryptocurrency fan, especially when we go from outside of Bitcoin and Ethereum and Ripple. I could care less about them. But the fact is, I own a couple Bitcoins. I've actually gotten them, accumulated them over the years, not as an investor. People were asking me to teach classes. And in order to teach the classes, I had to be more aware. So I would open up different kinds of wallets to see how the wallets work. And I would open up different exchanges, because when I had to explain how an exchange worked and how this type, I had to experience it. And, we're not talking about today with cryptocurrency being $10, $12, $14,000. We're talking about way back when Bitcoin was worth a couple $100. So it was a couple $100 that I put in to learn to teach this in my class. Well, let's forget about the big Bitcoin rally to 20,000. But Bitcoin's been going steadily upward over the last months, the last years. It's been following a very nice, well-defined trend. But every time it makes it to 12,000, it gets stuck. So I said, I'm sitting here with these couple of coins, and I've been watching Bitcoin move up and up and up and up and up. And this morning I said, over the last couple of days, actually, I was saying, if it hits 12,000, I'm getting out. Because I doubt it. It may get to 14 or 15, but it's probably going to go back down to 8 or 9. So this morning when it broke 12 and it was at 12,250, I sold my couple of coins. I got out of the market. But I was watching a trend. Okay. So there are all different types of periods or time frames in which we can trade these trends, and there's all different kinds of things. There's very few economic factors really affect Bitcoin. They would like us to believe that they are, but there really isn't. And personally, I don't believe, yes, a good jobs report might give the dollar a bounce. It might affect gold a little bit. A bad, economic decision or a decision by the ECB might push the euro down today. But in our type of trading, it's very hard to foresee these and trade these types of behavior. So one of the best things that we can trade is an easy to follow trend following strategy. So to apply the strategy, you must first be aware of the existence of a trend. Without identifying a trend, we would be gambling. And that's not the purpose of trading Forex. We're not looking to gamble. We're not looking to say, look, that's low. We're going to buy it now and it's going to jump up, later. Because that's just plain old luck. And what happens, you end up losing your money. So both fundamental and technical analysis can be employed for identifying a trend. So remember what I said a little while ago. I believe the markets are completely random. But there are certain times that the markets exhibit non-random behavior. This non-random behavior is known as a trend. And it can be a very short period of time or it can be a longer period of time. But when price starts moving in a well-defined trend, up or down, and we're talking about a well-defined, and you can easily find these in charts when you see these beautiful trends. Well, when price does do this, you can make some very smart decisions, because when price moves from random to non-random, we can apply a whole bunch of analysis. So it is generally a good idea to use a combination of technical and fundamental information when deciding on a trend's character and deciding on our entry and exit points. So general observation of a market swing points is the first point of call in determining if a market is trending. Okay, we've already talked about it. Markets are making higher highs and higher lows, higher highs and higher lows. So we want to use observation. Let's go over some live charts. Okay, here we can see what we could define as an uptrend, although I wouldn't use this as a trend trading strategy because this is just an asset that's kind of bounced back up. Okay, it's a short period. Yes, we could have seen this uptrend, but we don't see a well-developed push and ease, push and ease, push and ease. Again, here, at this point, look at this in this downtrend, and then when it recovered and went into this uptrend, push, ease, push, ease, push. Okay, now, we could be in the middle of an ease here, but the problem is this ease isn't making a higher low. Okay. So we don't really have, at this point, as we did from the end of September all the way up here until, actually, we would have said that this upward trend, even though price can continue up, this well-developed trend was over the minute it couldn't make a higher low. But the more defined you find these trends, the more well-developed they are. Sometimes the better you can trade. Now we have the Euro US dollar short-term chart. Push, ease, push. Now we're going to be looking for an ease. Now we're looking at a 1-hour chart. We can see it really, when we look at the trend over a longer period of time, we really don't have a pretty trend. Now we have an uptrend. We actually have a trend line that's a valid trend line, but we don't have a price movement for a trend trading strategy. We can apply a lot of other strategies. We can make a lot of trading decisions based on this price movement. I can make a trade here using my trend lines and my support and resistance lines. Okay, I probably could have gotten a good trade using my indecision candle. Okay, trade, but not using a trend trading strategy because it isn't a well-developed trend. It is just a price moving in a trend. And with a trend trading strategy, we're looking for well-developed trends. So you shouldn't have to think too hard about whether a market is trending or not. Most traders make trend discovery way too difficult. If you take a common sense and patient approach, it's usually fairly obvious if a market is trending or not just by looking at the raw price action on the chart. Make sure you mark the swing points on your chart, as it will draw your attention to them and help you see if you're making a pattern of higher highs and higher lows, or lower lows and lower highs. Now, technical analysis can suggest the beginnings of a trend, but it's unlikely to tell you much about the length or the strength of the same. So I suggest that you use both technical and fundamental methods for your trend following strategy, with fundamental factors eliminating the false signals of technical analysis and technical tools providing you the time price frame for deciding on entry points. So there are many technical tools that can signal the phenomena, but there are an equal number of false signals generated. So yes, you can use technical tools or technical indicators to tell you a trend is starting. Okay. But with a trend trading strategy, we don't need to be at the beginning of a trend. We need to see that we have this well-developed trend. Thus, it is always necessary to have at least a basic of understanding of the economic factors that help creating trends before deciding on the validity of a chart pattern. Now, what kind of price pattern will create a trend? The trend that we seek to trade is different from random fluctuations. Range patterns and similar price movements is that the price itself, in the absence of any technical indicator, can still be recognized as showing a trend. In other words, there is some driving conviction behind the price action, which allows the trader to easily identify it visually. Depending on the type of trend, that is an up or down, successive highs and successive lows, with relatively few irregularities. But such a case is often a rarity, and the trader will have to back his technical patterns with a conviction that can perhaps only be gained through fundamentals. So if a trend can be identified visually, why use technical tools at all? Even though we can notice the existence of a trend, we still need technical tools to trade it and to time it. Trending markets tend to make strong moves in the direction of the trend, followed by periods of consolidation or a counter trend retrace before the next leg in the direction of the trend. So you need to learn to identify the parts of the trend that we're in and understand where we stand. This will help you to avoid overtrading during choppy and consolidation periods and will give you a better chance of profiting when the trend makes a strong move. So you can see this well-developed, beautiful trend. Push, ease, push, ease, push, ease. This is what we see in the markets all the time. Now we can see that a trending market tends to move in spurts. Pushes and ease, push and ease, push and ease. Troughs and peaks, peaks and valleys, however you want to define them. Now, all trends are obviously not exactly the same, but we do typically see the general pattern described: a forceful move in the direction of the trend, followed by a period of consolidation or retracement in the opposite direction. Now, sometimes they're not pretty. Like silver up here on the top is an ugly, ugly, ugly move, but it fits all of the rules. Now, down below, the Dow Jones is easier to see, okay? But the ultimate thing that we have to be measuring at all times is higher high. Let me get my marker back on here for you. So, price moved up and made a higher high. It eased back down, but the lowest point in that move down was still higher than the previous low. Pushed back up to make a new higher high and eased back down, and the lowest point was still above that previous low. Pushed back up, and now it moved into this area of consolidation. Consolidation is okay. Move back up to make a higher high, and this is where we got the blow off top. But as we can see here, we don't know exactly what's happening here because we're still made a higher high until we couldn't make that higher low, and it broke its movement. At this point, that trend that we would have considered trading or would have been trading, we were out of the market. So retraces are important. Now, these retraces are when we have the highest potential of a high probability entry within the trend. Now, you're never going to catch the highest peak or the lowest valley in these retracements. Okay, you know, there's a name for it, like catching a knife. Okay, you'll never pick that exact peak or that exact bottom of the valley. So the fact is, we need to understand that they exist, and what we're looking for is when price has hit that bottom of the valley and starts moving back up. So we need to be able to enter this trade here. We'll never be able to enter it here. And then we can ride this wave up. Now, as long as price stays above that low here, we could stay in the market because that trend is confirming itself. Okay? And we could ride those trends all the way up. But we could also enter here and when it peaks out here, makes the higher high, and then starts easing back down, we could decide to exit the market if it doesn't sustain above this point in the trade. And because we can always re-enter. So keep that in mind. So it depends on your own strategy. Me, I'll take my profit, go out, and maybe come back in when I can redefine the next movement. So maybe I would have missed this because I would have bought here, sold probably around here, would have made this much profit. And then I would have then redefined a new trade and probably maybe got it in the market here and been able to ride it to there. So I would have lost that additional profit in between. And I might have never materialized the final trade. But I'm very, very, very conservative. And market timing is everything. Market timing never works when one is trying to predict reversal points on a technical basis. However, market time in the context of a trend with the purpose of picking the counter trend extremes and using them to enter a trade is necessary and profitable. And there lies the main principle of trend following strategy. Recognizing the trend, identifying the counter trend move, and use them to enter a trade in the direction of the trend. Pretty simple. So let me show you a little presentation that might show you this and help define it a little bit better.
With price action in two key ways. The first is for trend trading, and the second is for reversal trading. Let's start with the first, which is trend trading with trend lines. Now, here is exactly what you want to look for when trend trading with trend lines, which is an area where support or resistance crosses with a trend line. This axis point is also what we call an area of high confluence. Now, an area of high confluence is an area where a lot of traders have their eye on, meaning that there is a higher probability that traders will be taking action at these areas, which is when trade opportunities arise. So let's take this one step further. This area is of high confluence because different schools and types of traders are all watching it. First, you would have support and resistance traders eyeing this area for possible short trade entries. Second, you would have trendline traders eyeing this area for possible short trade entries. Third, you would have price action and candlestick traders eyeing this area for possible short trade entries. And fourth, you would have confluence traders like us who are eyeing areas like this where we know other schools of traders are watching for possible short trade entries. All these different types and schools of traders with different trading styles all eyeing this area for possible short opportunities is what can trigger a possible trade entry short. Now let's break this down step by step of what should be going through your mind as a trader. Also, to point something out, we are only using one time frame in this example, which is the daily time frame. And the reason this is important is because later in this video, we will begin showing you how to use multi time frames. So first, you would have established that this is a moving downtrend as price was making lower highs and lower lows. So you would want to trade with the moving downtrend. Second, you would have identified your trend line through these 3 points and drawn it in and had it stretched out further in case price came back up to it. Third, you would have looked left and spotted the support turned resistance level here and had it drawn in. Fourth, you would have then identified this area of high confluence where your trend line and resistance level intersected, which means there would be possible short trade opportunities once price got here. Fifth, when price started to approach this area, since you had this area already identified, you were watching to see what price would do once it got here, aka price action. So you were probably thinking, why not just enter a trade short right away once price got to this axis point? Again, as a reminder from past videos, it does not matter how good an area is. You do not enter trades blindly once price gets to these areas. You always wait for price action because price can easily blow right through. So you then had a reaction to the level through these 2 red candlesticks not breaking through and bouncing downwards. Now, at this point, there is still no trade short because a reaction to an area does not equal a reversal. It could just bounce or stall at a key area and then still break right through. Do not forget that this is a moving uptrend. Now, here is the trick. In order to enter after a rejection of a key area of confluence, you put a trend line under the immediate moving trend. and wait for a break of the trend line to occur in order to confirm that the moving uptrend is over and that the bigger downtrend can continue. This is a very important concept to understand, because even though your bigger trend is a downtrend, your immediate trend is an uptrend, and the moving uptrend can continue and break right through and trigger a larger trend change. This is why it was so important for the short-term trend to be over through the trendline break so that the bigger trend can continue. Now, the most important point here is that the break of the short-term trend line occurred after the rejection and bounce from an area of high confluence, or else you would have just had a short-term trendline break and nothing else. Now, this is a lot to take in, so let's recap this one more time to drive the point home. First, your big picture trend was a downtrend, so you had a big picture bearish bias. The problem is your short-term trend was an uptrend, meaning price is currently moving with bullish momentum and can easily break right through your long-term trend line. This is why we needed to wait and see if we could get bearish price action to occur inside of the short-term uptrend, so that the short-term trend would be bearish to match the long-term bearish trend. Your bearish price action then came in two parts. The first was a reaction to the access point and area of high confluence, but more importantly, the confirmation of this was through the break of the short-term trend line. And at this point, the short-term trend was bearish to match the big picture bearish downtrend. You could then take a trade on the break of the trend line, a trade through the intraday timeframes, through a momentum play, or using any of the other strategies, as you now have your directional bias confirmed as short or down. Now, here's where you take your trading to the next level. If we had good candlestick patterns occurring right at this access point here, you would have placed a very short-term trend line up tight like this and waited for a break of this tight trend line on the lower time frames and take an even earlier entry, which we'll get into right now. So let's jump to that.
Trading the trend is not as simplistic as it sounds, but is not overly complicated. It's a matter of using your eyes, looking at the trends, looking at the price movement, and seeing what's happened as trends make higher highs and higher lows. So as you can see on this chart on your screen, look at this. We could have traded this price movement all along, trading uptrends and downtrends while we were trading the overall move and getting in each one of these trades just after the retracement had occurred. And we could have gotten this whole trade, this whole movement, which went on for a couple months. We could have gotten in 17 different trades. All would have been successfully profitable, all following a trend trading strategy. Now, a lot depends on the term and the nature of the trend following method and the trend you're looking at. The more well-developed it is, the better quality it is, the more trades you're going to get. But you also have to know how to place your stop loss and your take profit so that you can take advantage of these. So a stop loss can be placed a short distance above or below the trend line, whether it is provided by using a moving average or a simple line drawn on your chart. In my opinion, the trend follower should not realize his profits until he has a good reason to do so. And the purpose of this strategy is to focus on underlying price dynamics by stripping out volatility and short-term movements. And there's a little logic to realizing profits in response to fluctuations that are irrelevant to the main action of the trend. So basically, if price remains moving up, making higher highs and higher lows, you can leave your trade run. A lot depends on your trading philosophy, your trading strategy. Like I said, I'm ultra conservative. Okay, so I have my rules for when I would take my profits. But ultimately, we should look to let it ride while the trend is still holding tight. So this trading method involves a risk management component that uses three elements. Volume, and this one thing's like volume should support each one of your trading decisions, because when you see the retracement and you've waited for it to bounce off the bottom or bounce off the top and then confirm, the final confirmation should always be volume. Volume should steadily increase if the trend is going back into action. Okay, so we need to look at volume and the current market price as well as current market volatility. An initial risk rule determines also the position size at the time of entry. Exactly how much to buy or sell is based on the size of the trading account and the volatility of the asset. Changes in price may lead to a gradual reduction or an increase of the initial trade. But on the other hand, adverse price movements may lead to an exit. This really depends on your overall trading plan and your risk management strategy. So ultimately, the first thing we need to look at is price. One of the first rules of trend following is that price is the main concern. Traders may use other indicators showing where price may go next or what it should be, but as a general rule, these should be disregarded. A trader needs only to worry about what the market is doing. Okay. Next, we need to have our money management component. Money management is another decisive factor of trend following. It is not the timing of the trade or the indicator, but rather the decision on how much to trade over the course of the trend. Risk control, cutting losses, is a rule. This means that during periods of higher market volatility, the trading size is reduced. During losing periods, positions are reduced and trade sizes are cut back. The main objective is to preserve capital until a more positive price trend reappears. So, rules. Trend following should be systematic. Price and time are pivotable at all times. This technique is not based on analysis of fundamental supply and demand factors. So in Forex, bearish and bullish trends are typically equal, as violent and potent. So in other words, when price moves up, and one of the reasons Fibonacci retracements are so dependable is in the Forex market, price will tend to go down in a hard downtrend, but it will tend to recover in an uptrend equal to the amount of the distance that it moved in a downtrend. Because you really don't see, the euro has been like technically around 118 for quite some time. Now it's dropped down to 116. It's actually dropped down to 111 and 112. But then it goes right back up to 119, just under 120, and comes right back to the 118. In the equities market, it's usually about a 50%. Okay. So understanding the market you're in and how volatility is affecting it and what elements are important. So the simplest rules presented here are good enough to replicate the performance of many large name trend following hedge funds. In my personal preference, I've detailed these several different ways. Okay. But make no mistake, the trading system rules is the least important component of your trend following strategy. You need to look at position size, your trend filter, the quality of the trend, how you're going to get your entry points. And remember, there's an old adage that goes, the trend is your friend until it ends. So this one line pretty much sums up the quandary that traders are faced when trading trends. While a bias has been exhibited in the marketplace and may continue, there is no such thing as a surefire trend continuation setup. So when the trend doesn't continue, the trader is often advised to look to mitigate the loss and get out of the market. So one of the other indicators that might work well for you, RSI and MACD, are very good to help you see when the trend is moving, when it is recovering, when it's retracing. And then lastly, you need to always have exit signals. Because remember, trading a trend following system on a single market or only on a few different markets is suicidal. Because you can't sit here and say, I'm going to trade the euro and the euro crosses and hope I'm going to get a well-defined trend. You could go on months and months without getting this well-defined trend of higher highs and higher lows. Even though price may be moving up, you may not get the well-qualified trend. So if you sat and that was the only strategy you're using, you could sit for long periods without having any trades to do and nothing to do, and you're just waiting. So the nice thing about being able to trade CFDs and using computers now and all the modern charts is we can go through a lot of assets very quickly to see if they have a well-defined, qualified trend developing, not just an up move or a down move. So remember, trends develop for a reason, perhaps due to a shift in the economy's fundamentals. Trends show a bias that has existed on a chart. While the future is opaque and unpredictable, this bias may continue. Now, you have to keep in mind that trends take a lot of work. Pushing the price up and up and up and up takes a lot of effort by traders. But once it starts moving, it becomes a self-fulfilling fantasy. It's sucking in the buyers. And a downtrend is sucking in the sellers. And it's just like a hamster running in a cage, turning that wheel. Once he gets that wheel turning, it's very easy to keep it turning. But getting it started is difficult. So when a well-defined trend starts happening, it will usually continue on for quite some time. Now, after all, the future is unknown, and nobody has a crystal ball that will magically foretell tomorrow's price movement. But the fact of the matter is that biases do exist, trends do take place, and in many cases, these trends may continue. So keep that in mind. Think about trading trends as a simple little strategy. It's not very complex, but you have to wait for them to exhibit themselves. And remember, keep in mind, volume is your final confirmation. Volatility is a threat. And you want to let your trades run for as long as you can. And remember, own it. Keep it simple and just get it done. Thank you very much for joining us today. If you do have any questions you want